The Canadian housing market is about to change dramatically. There's no doubt about it. Starting December 15th, new federal mortgage rules will make it easier for many Canadians to buy homes, particularly first-time home buyers and those eyeing higher-priced properties. But here's the catch. While these changes may boost home sales and prices in the short term, they could also create new affordability challenges and financial risks. If you don't understand how these new policies will impact the market and potentially your buying and selling strategy, you could miss out on opportunities or even make costly mistakes. So let's break down exactly what these changes mean for you. One of the key measures is the expansion of the maximum mortgage amortization period for first-time home buyers with insured mortgages from 25 to 30 years. This change also applies to newly built homes, regardless of if you're a first-time homebuyer or not, and the purpose is to aim to revive pre-sales and support housing construction. And while this policy is beneficial to the new home space, the primary focus is on the impacts on the resale market. Historically, similar policies such as the introduction of 30-year insured mortgages in 2006 had a statistically significant but relatively small impact on home sales growth. The expanded amortization period could increase purchasing power for first-time buyers by approximately 8 to 10%, comparable to an 80 to 100 basis point reduction in interest rate. However, this benefit is limited as it only applies to insured mortgages, which make up about 20% of the mortgage market. Additionally, only 44% of home buyers are first-timers, according to the Bank of Canada data, further narrowing the policy's reach. Another major policy change is raising the cap for insured mortgages from $1 million to $1.5 million. This adjustment allows buyers in high-priced markets like the Greater Toronto and Greater Vancouver areas to purchase homes with lower down payment requirements. For instance, a buyer purchasing a $1.2 million home in Toronto could now put down $95,000 instead of $240,000. About 20% of Canadian homes fall within the $1 to $1.5 million range, indicating potential for significant activity, particularly in the GTA and GVA. However, the policy's impact may be muted as most buyers in this price range typically have down payments exceeding 20% and do not require insured mortgages. While these policies aim to increase affordability, they also highlight challenges for potential buyers. For instance, a $1.05 million home would require a household income of $170,000 to $180,000 to qualify, and a $1.45 million home would require around $225,000 to $245,000, which is beyond the reach of many households. Looking ahead, the federal policies are expected to lift Canadian home sales and prices by 2 to 4 percentage points by the end of 2025. However, much of this growth will occur in the first half of the year, as the affordability erosion caused by rising prices is likely to offset the initial gains. By the end of 2026, prices and sales may be only marginally higher than they would have been without these measures. Additionally, these changes could lead to increased reliance on insured mortgages and longer amortization periods, which comes with its own risks. Research indicates that borrowers with higher loan-to-value ratios or longer amortization periods are more likely to experience financial stress. Delinquency rates are also higher among insured mortgages from non-bank lenders, which could introduce vulnerabilities into the financial system. In conclusion, while the federal mortgage rule changes will provide a notable boost to Canadian home sales and prices, their impact will be tempered by broader economic and market factors. The focus on first-time home buyers and the targeted price range may limit their effectiveness. However, these measures represent a step towards supporting housing activity and affordability, even as they encourage households to take on more long-term debt. Balancing these benefits and risks will be key to achieving sustainable growth in the Canadian housing market. And a couple of areas where I do see these changes making the biggest impact is going to be at the lower end of the market with first-time home buyers, as it's going to increase their buying power by about 8 to 10%, putting more pressure on the bottom of the market. Additionally, individuals who are looking to upsize or cross the $1 million threshold but not go all the way up to 1.5, so let's say somewhere in the $1 million to $1.2, $1.3 million mark, potentially a house with a suite, I think there will also be a great impact in this area of the market of those individuals who are either going in with family, friends, or otherwise, or making the upsize in order to get into that market. But let me know, what do you think? What sort of impact will these new mortgage policies have in the market, if any? And if you're looking to get a mortgage pre-approval for yourself, there's a link down below in the description which can get you started right away. Additionally, if you are looking to buy, sell, or invest in my marketplace of Surrey, Langley, and the rest of the Fraser Valley, or you just want to chat about real estate, you can scroll down and click the first link in the description to book a call with me at a time that works best for you. Thanks so much for watching. Make sure you check out another video on my channel before you get out of here, and we'll see you in the next video.